2021, GameStop stock climbs 1,700% in a single week. Financial news anchors are confused, hedge funds are bleeding billions, and people on Reddit, trading from their bedrooms on their phones, are bringing some of Wall Street's biggest players to their knees. It sounds like the retail investor finally won, like the system finally worked the way it was supposed to. But that's the exact moment Robinhood, an app that calls itself the people's trading platform, suddenly removes the buy button. Only for GameStop, only when retail was winning. No law was broken, no crime was committed, and yet that single night showed millions of people something Wall Street will never admit out loud. The stock market isn't a fair game. It's a design. And that design doesn't play by the same rules for every player. Today, we're going inside that design. Why this matters right now. If you think this is just a weird 2021 story, think again. By 2024, more than half of all daily trading volume in the US stock market is handled by high-frequency trading firms, companies that don't use humans. They use algorithms that execute trades in microseconds. By the time a human blinks, thousands of trades have already happened. And this shift is happening in India, too. Algo trading's share on the NSE keeps rising, and retail participation is at record levels. In 2019, there were roughly 40 million DMAT accounts. By 2024, that number crossed 150 million, which means millions of new people are entering this game, and most of them have no idea how the game was actually.
This isn't financial advice. This is a reality check about what you're actually stepping into when you say the word market. How the system actually works. The textbook definition is simple. The stock market is a place where companies raise capital and investors buy ownership in them. Price discovery happens. Demand sets the price. That definition was accurate in the 1950s. Today, it's incomplete. Today, when you hit buy, your order doesn't go straight to the stock exchange. In most cases, it first goes to a market maker, a private firm that executes your order using its own inventory. In the US, this is called payment for order flow. Brokers sell your order to these firms. Those firms profit from the spread on your trade. So when you think trading is free, in reality, you're the product. Your order flow is what's being sold. And that's just one layer. Above that sit high-frequency traders who literally place their servers right next door to exchange servers just so their data arrives milliseconds earlier. This is called co-location. It's completely legal. And it creates a permanent structural speed advantage that no retail investor can ever match. Then there's passive investing, index funds and ETFs, which today control roughly 45 to 50% of US market cap. These funds don't buy based on how a company is performing. They just follow a formula. This stock has this weight in the index, so we need to buy this much. This creates a whole new problem, one we're about to get into. The hidden mechanism. The uncomfortable math. Here's the part most people don't understand. When index funds buy companies based on their index weight rather than their fundamental value, price discovery, the entire original purpose of the market, starts to quietly break down.
In simple terms, a stock's price now reflects less about how good the company actually is, and more about how much passive money happens to be flowing into it. According to 2023 Bank of America research, the top 10 stocks in the S&P 500 account for almost 30% of the entire index's weight, the highest concentration seen in decades. Which means when you buy a diversified index fund, you're actually heavily concentrated in a handful of companies. Now add another layer, stock buybacks. Instead of reinvesting their profits, companies buy back their own shares. In 2022, S&P 500 companies combined spent roughly $923 billion on buybacks. In several sectors, that number was higher than their entire R&D spending for the year. Buybacks reduce the number of shares in the market. Fewer shares automatically means higher earnings per share, without the company's actual business performance improving at all. Which means a company can partially engineer its own growth story
just by buying its own stock. This isn't illegal, it's completely normal. And it does exactly what a fair, transparent market isn't supposed to do. It disconnects the numbers from reality. Let's put them side by side. The hype. The stock market builds long-term wealth.
Just stay patient, invest regularly, and the market rewards everyone eventually. The reality? Long-term average return data is real, but it's an average, and averages hide individual experience. From 2000 to 2010, the S&P 500's total return was roughly flat. This decade is literally called the lost decade. For people investing to retire around 2000, long-term didn't work because their long-term had already run out. The hype. The market is efficient. All information is already reflected in the price. The reality? Before the 2008 crisis, mortgage-backed securities were rated AAA, the highest possible safety rating. The market priced them as safe. They weren't safe at all. The same rating agencies were being paid by the very banks whose products they were rating. The hype. Retail investors are now on equal footing with institutional players. Apps, information, everything has been democratized.
The reality? Information has been democratized. Speed hasn't. Access hasn't. And most importantly, the incentive structure hasn't. During the GameStop episode, Melvin Capital and similar hedge funds received emergency capital, billions of dollars, within hours through private negotiations. Retail investors never had that option. When the market crashes, the big institutions that are too big to fail get bailed out. The small investor who loses their entire savings gets no bailout at all. This isn't hypocrisy. This is the system working exactly as it was designed to. Let's step back for a moment. The original purpose of the stock market was to give companies capital so they could grow, create jobs, and innovate. Today, a huge portion of the market has drifted away from that purpose. Most trading volume doesn't create new capital anymore. It just moves existing shares from one hand to another at algorithmic speed. And when a market becomes this heavily financialized, it creates a new kind of risk, systemic fragility. In 2010, the flash crash happened. In just 36 minutes, the Dow Jones dropped almost 1,000 points and then recovered. The cause? One algorithm triggered another, which triggered a third. No human was anywhere in that decision-making chain. That was a small preview of how quickly a tiny error can cascade when machines are the ones controlling the market. And when central banks, like the US Federal Reserve, cut interest rates and pump liquidity into the market, stock prices rise, regardless of whether the underlying company's actual earnings have improved. In 2020-2021, while the entire global economy was shut down, the stock market was hitting new record highs. That disconnect wasn't a coincidence. It was the direct result of trillions of dollars in stimulus flowing into the market. Which means the market is no longer just a reflection of how companies are doing. It's now a reflection of liquidity, policy, and algorithmic behavior. And the more retail investors, millions of people, in India too, enter this system without understanding it, the more this disconnect ends up shaping their actual financial future. So the question isn't really whether the stock market is broken. The question is, can a system that's unequal by design, sold to you under the label of fair opportunity, ever genuinely be fair? Maybe the market was never a level playing field to begin with. Maybe it's always been a game where a few players write the rules and everyone else just plays. And if that's true, the real question isn't whether you should invest in this market or not. The real question is, when you do invest, do you actually know what system you're becoming a part of?